All right. So good afternoon if you're in Europe. Good morning if you're in the United States or Latin America. We are here for a very interesting discussion on George Soros's Project Syndicate contribution earlier this week, Bonds or Bust. Rob, who's the moderator today, will give a quick introduction to the article and the motivation behind it. But I will quickly also just remind you and tell you that this is part of the YSI Political Economy of Europe working group. And I would like to just now also quickly introduce and mention the two coordinators who are present here today, Stefano Merlo and Salome Topuria. They'll be jumping in later in the discussion when we're opening it up. But for now, allow me just to briefly introduce our great panel, which came together very quickly. And I really appreciate everybody taking this invitation on short notice. Of course, I should maybe introduce myself too. My name is Jay Pockling. I'm one of the managers of the Young Scholars Initiative. I'm really happy to do this initial invitation before I hand it over to Rob. So first off, let's give it up for Philippa Sigl-Glöckner. She is, amongst many other things, the founder of Dezernat Zukunft, a nonpartisan think tank that aims to explain and rethink monetary, fiscal, and economic policy in an accessible, coherent, and relevant manner. They're based in Berlin, and Philippa, I'm really glad to have you here today. Then we have Peter Buffinga. He's a professor at the University of Würzburg, and a former member of the German Council of Economic Experts, also known as the Wiseman. Thank you very much, Peter, for joining us. Then we have Thomas Fricke, who is the founder of the Forum for a New Economy, and he used to be the chief economist of the Financial Times Deutschland. Thank you, Thomas, for accepting the invitation. And finally, to round out the panel, we have Anatole Kaletsky. He's the chief economist at Gaveco Dragonomics, and of course, also, as you know, a member of the INET governing board. Anatole, also thank you very much to you for joining us today. And without any further ado, I'd like to hand it over to the president of the Institute for New Economic Thinking, Rob Johnson. Take it away.
Thank you, Jay, and good day, everybody. So George Soros wrote a piece for Project Syndicate, which was released on November 30th, called An Effective Response to Europe's Fiscal Paralysis. The paralysis comes from the veto of the union's budget and the COVID-19 recovery fund. And George has a series of assertions that I'd like our panelists to explore. The first is, I guess, the question, are funds needed? And if so, how do we overcome this blockage that he refers to? Secondly, he posits that from the Lisbon Treaty, there was something called the so-called enhanced cooperation procedure. It could be used for a subgroup to set budgets and issues and then issue a joint perpetual bond. Third is, should it be a perpetual bond? Is there an appetite for these bonds among the insurance companies and long-term investors that George cites? And finally, he makes kind of a plea for the common good in the case of Italy, where Italy would not be able to issue a perpetual bond, and suggests that some of the other EU members band together and contribute some of the support to their well-being. So I'd like to start with Philippa, and then we'll move to Peter Bofinger, Thomas Fricke, and then Anatole Kaletsky to react and synthesize and assert his own feelings about what George has put forward. So Philippa, please, I'd welcome your opening remarks right now.
Thank you very much for putting me on the spot here. No, it is a really, really interesting topic. Thank you for inviting me and pulling this together at such short notice. It's fantastic. So going roughly in order of your questions, are funds needed in Europe for European recovery, but maybe also for the broader European project? I'm not sure there's that much to debate here. I think we all agree that funds are needed I think we all agree that Hungary and Poland at the moment stalling on the recovery fund is a big problem. Perspectives may differ on how it can be overcome, but do we need shared European funds? I guess that's a yes, and I think it's hard to argue otherwise. Then there was a specific proposal made by George Soros on the enhanced cooperation, and that basically certain nation states that have kind of very high trust in their bonds could issue perpetual bonds. And then from what I understood from his proposal, the idea was that also they could guarantee other countries like Italy so that they could issue perpetual bonds eventually as well. I think that's an interesting proposal. Perpetual bonds, if we want to foster a closer union, are obviously, I think, one tool to do it, because you show, and I mean, George mentions this in his opinion piece briefly, that this union is here to stay. It's not one with an expiration date. So I think from a symbolism perspective, it's quite interesting. And also when you think about perpetual bonds, I mean, what are they? In a way, they're actually quite different from bonds with a maturity date. How I think about them, they're much closer to actual money, because the investor has no guarantee date when they can give it back. They issued something, and then they have this piece of paper. The government can pay them out, or whoever the issuer is. The only difference, or maybe there are two differences to money. One is if there is a positive interest rate on it, you know, they get paid on a regular basis, which may or may not be the case. And then secondly, you probably can't use them to buy a burger in a shop. So you have to trade them in for something else to do business in the real economy. It's essentially money for financial markets, but in a way much closer to money than a real bond. There is then this assertion in the opinion piece, and Rob, you mentioned it now as well, that this might be cheaper, that there's a lot of interest because a lot of investors are looking for investments with long duration. Insurance companies, I think I mentioned specifically, and I guess that kind of resonates with what we've all seen in the bond markets, and more countries issuing very long-term bonds. I mean, Austria having a lot of success with a 100-year bond. For me, the question here is, are ultra-long bonds similar to perpetual bonds or not? And I would probably argue they are not. They're quite different because of the reasons I mentioned earlier. And what do they do, and how are they different in terms of, I guess, risk allocation? If you have a very long-term bond, that still tells an investor exactly when they get paid back out, and when they can reallocate their money. On a perpetual bond, the risk is totally one-sided. The issuer can pay it down or cannot do it, and the investor can't really do very much about it. So I think there's quite a big difference between an ultra-long bond and a perpetual bond. And hence, I'm not sure that the interest we see in ultra-long bond translates necessarily into perpetual bonds. I actually think this is kind of for experts in our tour, who will be much better positioned to answer this. But my hunch is, I'm not sure it will be cheaper to issue a perpetual bond than a long-term one. Hence, I guess I think I'd be very interested in long-term bonds, and think maybe this is a more viable option at the moment, and quite an interesting one. Might not be a huge secret that a few governments are thinking about extending the range of maturities they offer, and maybe this is the slightly more realistic proposal to think about. And maybe this already addresses and it doesn't mean to switch to a fundamentally different instrument that's quite tricky in terms of regulatory treatment, in terms of how the rating agencies look at it, and that's new to investors.
Very good, thank you. Peter Bofinger.
Yeah, thank you very much for inviting me. It's a very challenging proposal, very interesting topic. And I think Philippa has already said a lot on the problems of these perpetual bonds. I think the proposals that George made are two. One, the first proposal he made was for a perpetual bond for the EU, for raising funds by the EU. And now the recent proposal is using perpetual bonds for the financing of individual countries. I think these are two separate issues that should be discussed differently. So as far as individual countries are concerned, I'm not really convinced that this is an improvement over, let's say, 30-year or 50-year bonds. That's what Philippa said. And George himself says there might be a risk premium attached to it because investors are not used to it. And there might be also a risk that the markets are not so happy with these long-term bonds because of a lack of liquidity, at least in the beginning. So I think the introductory phase of such a long-term bond might be perpetual bond might be difficult. I see an additional problem with these perpetual bonds. I'm not sure whether the ECB would be able or willing to purchase these bonds. So far, I think the ECB stops at 30 years. And so if you issue a bond which will not be purchased by the ECB, that will be also a problem. And so for individual countries, I don't see the specific advantage of the perpetual bond over, let's say, 30 years or 50 years. That's exactly what Philippa said. So maybe one should try it, but I don't think it has the idea that it makes borrowing cheaper is not so clear. Of course, there should be an interest in countries to increase the maturities of bonds in general in order to benefit from the very low interest rates right now, and so to say to hedge their debt against increased interest rates. But the specific case for perpetual bonds is not obvious. When I read the proposal, I thought maybe it helps in terms of debt statistics, so that maybe under Maastricht criteria, the perpetual bond maybe it's not counted, but that's not true. So I've asked the people in the Bundesministerium for Finance, and they said no, the principle counts whether it's perpetual or short-term. So that does not really help. Then there's a question, would it increase the willingness of Germans to guarantee for Italy's debt? And I also don't see that. Of course, you could say, well, it's a difference whether Germany has to guarantee, let's say, 100 billion Italian bond, or whether they have to guarantee, let's say, 1 billion per annum for the Italian bond. But I'm not sure whether this would really convince the Germans in the end. It would be a guarantee for Italian debt, and I think Germans don't like it. So now, first I was talking about the perpetual bond for individual countries. I think it's a completely different story if you discuss a perpetual bond for the EU or for a fund that is issued by some EU members. Here, the advantage, in my view, is there because, as you can see, with the recovery fund, the member states only guarantee for the annual payments that the EU has to make. So it's about 0.6% that is guaranteed annually by the member states. And of course, now if the EU issues a perpetual bond instead of a traditional bond, then of course the annual payments that have to be made are much lower. And so in this context, it would be quite interesting to say, okay, we only need 1% or 1.5% or even 0.5% of interest payments annually as EU, and only this amount would have to be covered by guarantees of the member states. And in this regard, I think it's quite interesting thing, because here it looks much better, so to say. And then, of course, there was in George's paper the additional idea to say, let's have an enhanced cooperation procedure for the willing countries, and these smaller group of countries could set up a common fund. And I think this could be interesting, I'm not sure, as a threat to Poland and Hungary, saying if you are not willing to participate, we stop the whole procedure as an EU venture, and we do it with a limited group of countries, and so you are out. I think that's something which I don't know how it would function politically, but of course you could say all the things that we have agreed so far on this on this recovery fund, we stop it as an EU endeavor, we do it as an enhanced cooperation procedure, and Hungary and Poland are out. So I think that's a very fascinating idea, even as a kind of credible threat, even if it doesn't work. But I think that would be very nice, because Poland and Hungary are the main beneficiaries, among the main beneficiaries of that fund, and say, okay, if you don't like it, we set up a smaller fund, excluding you, and we don't do it as an EU initiative. So I think this idea that is also in George's paper is quite fascinating. Thank you.
Thank you, Peter. Thomas Fricke, please.
Rob, thanks. Thanks for inviting me, and that's indeed very, very interesting, very important topic. Just Peter, if I understand correctly, that's something that is already debated to kick Poland and Hungary out of this next EU generation fund. So I think that's not so unrealistic as it seems, perhaps, to do politically. I think the proposal is quite interesting in general terms, because that's another way, and we need to find another way to go this direction and to share responsibilities in the EU. And we have this additional problem of Poland and Hungary and some others, as you know, and that's to be overcome. So the idea to have this sort of an enhanced cooperation with some countries is extremely important and interesting, and as it has been shown in the EU history, very often these things have gone this way. So that's something that some people did, and just to refer to Valéry Giscard d'Estaing, who has passed away. That's something that he did with Helmut Schmidt at the time for something which has led even to something like the euro in an indirect and long-term perspective. So that politically, I think, a very good idea. And economically, I think there's a good argument. I share, and you're much more expert, Peter and Philippa, in this, the concerns on the difference between perpetual and very long-term bonds, and the advantages or disadvantages or small advantages in that. I think one of the main political questions that came to my mind quickly was something that Peter already mentioned, is how to convince these countries. And if we talk about some countries who would go ahead, it's certainly mostly and most critically Germany to convince to do this and to go ahead. There's been a fascinating study recently published by some economists, German and Italian economists from Max Planck Institute, on the willingness of Germans and Italians to stay in the euro, to help each other, and so on. And that was an experiment with people survey that showed something quite interesting, maybe obvious, but interesting, that in general, if you'd asked people in Germany just like that, the majority would say, well, we're not there to help Italians. Then they asked, and that was the question they asked before COVID. Then they asked the same question in the COVID crisis, and already the answers were different, and people were much more willing to help Italy, because it was an obvious case of a country that needs help. And then the second thing they did is to ask the people to add an information to this question and say, well, you know that if we don't help Italy, the probability is quite high that they will exit from the euro, and this will have consequences for the German economy. And confronting people with this very simple idea changed their answers. And in the end, adding the two elements, COVID crisis and the prospect of negative impact for Germans, which is a very self-interested argument, added up to, in the end, in this condition, this framing, 60% of Germans said, well, we want to help Italy and we want Italy to stay in the euro. What does that mean? I mean, it's one of the most critical questions, but it's interesting to see that apparently even these Germans who seem to be very reluctant may be convinced, and they may be convinced on the one side by something which is very, let's say, human, a very good argument to help other people, but at the same time to argue that in the self-interest, it's in their self-interest to help. And this may be a key to understand and to discuss when we want to go in this direction, like George has proposed in that sense, and go ahead with individual countries. We need these two elements. And then maybe it gets tricky because there was a high willingness at the high time of the pandemic last summer. Not sure if it's the same today, and the self-interest of Germans to help Italy is to be developed. I think that's not gone through in Germany. There is also still a lot of potential to convince people on these economic side. So these are two things that need to be done. And just to add the last thing on the potential to argue all this in Germany. As Peter and Philippa, you've seen this poll last week on where Germans were asked if they find it okay that Germany's government has such a debt now to finance the pandemic or the fight against the pandemic and the economics. And about 70% of Germans said yes, that's okay, and that's quite astonishing if you compare it to the cliché of Germans who don't want to debt. So maybe there's more potential to argue, but there's a lot of things that need to be argued to convince people in Germany to go this way.
Thank you, Thomas. Anatole, your thoughts?
Yes. I have the privilege of speaking last, and therefore what I can emphasize is where I disagree with previous speakers, because the three of you have filled in much of the background, and there are most points obviously we agree, but there are a number of points of disagreement which will perhaps generate an interesting discussion. So it seems to me that really there are four questions that need to be answered. One is more money needed by the EU or national governments? Secondly, is it desirable or is it now necessary to do it on a national basis rather than a European federal basis? Thirdly, is this financially feasible? And fourthly, is this politically feasible? So I think on the first two, we have a consensus and there's nothing to disagree with. We all agree that more money, substantial amounts in the trillion euro range are needed over the next few years as a result of COVID. And secondly, while doing it on an EU-wide basis would be the first best solution, I think we all agree. I think we also agree, and I would certainly strongly endorse this, that using the principle of enhanced cooperation, allowing national governments, 25 out of the 27 national governments to go ahead, and thereby really overcoming the blackmail that the EU faces now from Poland and Hungary would be very desirable. So I think we can all agree on that and set it aside. The interesting questions to me are the third and fourth. Is this financially feasible and is this politically feasible? And this is where I'm actually more positive, and I disagree with a number of the points made. First of all, I think that there is no substantial difference, and here I disagree with Philippa, between perpetuals and 100-year bonds. In theory, you can argue that a perpetual bond is more money-like because there's no repayment obligation and so on. But in practice, a bullet repayment obligation 100 years off if there isn't a sinking fund, and all the 100-year bonds, as far as I know, do not have sinking funds, is in practice with even very, very low discount rates equivalent to no repayment at all. So from a financial market standpoint, I don't know about how theoretical economists see it, but certainly from the point of view of practitioners in financial markets, there really is no significant difference between perpetuals and very, very ultra long bonds. Now, the reason that is an important question is that there aren't any perpetuals left in the markets now because the Britain's perpetuals issued after the Napoleonic Wars back in the early 19th century were all redeemed roughly 10 or 15 years ago. So there are no perpetuals out there that I know of, but there actually are a number now, quite a large number of 100-year bonds. And therefore we can use the experience and in fact the yield, the market experience, and in fact the financial realities, the pricing of 100-year bonds as a useful benchmark to tell us how perpetuals would work. And the fact is, and it's pretty spectacular, the Austrian 100-year bond is now trading in the market with a yield of about 80 basis points, 0.8%. It was issued originally with a yield of 2.5%. Anybody who bought that bond at a yield of 2.5%, I think about 3 or 4 years ago, is now looking at a capital gain of 85%. This has been one of the most profitable financial instruments in the market, but I certainly wouldn't buy it at 80 basis points. But the fact is, anybody who does buy it at 80 basis points, if that yield falls to 40 basis points, will more or less double their money yet again. So these, at least in the case of a AAA or AA rated borrower, these 100-year bonds are attractive instruments, and actually perpetuals would be probably even more attractive than the 100-year bonds because of the simplicity of the simple inverse relationship between the price and the yield. The second point on which I disagree somewhat with the others is that actually the debt servicing costs are more important than the overall levels of debt. And here, this is a point that Peter made. Well, these perpetuals would still count as, in their full value against the debt benchmarks. That's perfectly true. But actually, what we all know, what matters from an economic standpoint is not the level of debt relative to GDP, it's the debt servicing cost relative to GDP. And the debt servicing costs are going to be much lower, not just because the coupons potentially available are, let's say, 80 basis points or so on, but also because if there is no sinking fund, if the perpetuals don't have to be redeemed, or indeed, frankly, I'd be just as happy with a 100-year bond issue by Germany or France, or indeed Italy, which I'll come back to in a minute, as I would be with a perpetual. If the repayment obligation is stretched over 100 years, this is a completely different level of debt servicing obligation from a sinking fund on a 20-year bond or a 30-year bond, where you're actually repaying between 3% and 4 or 5% of the bond every year. So that's the other attraction. The third point is that even Italy would not need a guarantee from Germany to issue an ultra long or a perpetual bond. And the reason I can say that with absolute certainty is that 2 weeks ago, a country with far worse debt characteristics than Italy issued a 100-year bond at a yield of 2.55%, which was oversubscribed. What was that country? Peru, a country that has repeatedly defaulted over the last 20 years, which is now in a state of political chaos, has issued a 100-year bond at a yield of 2.55%. Given those market conditions, I feel sure that if Italy came to the market with a 100-year bond, if not a perpetual bond, it would probably be able to issue it also at a yield with a 2 handle on it. Would it be 2.3% or 2.6%? But certainly a very attractive yield given the absence of any kind of sinking fund obligations at that bond length. And finally, a number of all the other speakers have said, well, the markets might not like this. This might not be liquid enough. This might not be attractive. Well, the only way to find out is actually to issue it. You know, as economists, you don't have to believe fully, you buy into the whole rational expectations Kool-Aid to say that the only real test of where, you know, of financial acceptability is what the markets would do. So I think a proposal to issue a limited issue, not, of course, not €1 trillion, but let's say 100 billion euros divided between the 25 European borrowers of issue of either perpetual or 100-year bonds would be actually, I think, a very attractive one, certainly a more attractive issue than the one by Peru, or incidentally, the 100-year bond issued by Argentina about 5 years ago at a coupon of 7.5%, where investors have already lost 60% of their money just in the last 3 years. So I think it is financially feasible, which leaves the final point, is it politically feasible? Now that, I think, is the main issue that is certainly open for discussion. And here I probably would have to defer to Thomas and Peter and Philippa, because the question of whether the German public would accept it, the Dutch public would accept it, is crucial. But the strongest argument for them is the one that actually George Soros has made in his argument. This would save their own governments enormous amounts of taxpayer money. And I think that is a strong argument that at least, again, ought to be market tested in the political marketplace, just as the financial feasibility of these bonds should be tested in the financial marketplace. Thanks.
Thank you, Anatole. Philippa or Peter, Thomas, you have comments on each other? Just wave your hand. Okay, Philippa, please. And then Peter.
I have a short comment on the difference between ultra long and perpetuals. I mean, there are no public bonds out there that are perpetuals, but from what I understand, there are quite a lot of bonds from banks and even the corporate sectors outstanding that are perpetuals. They seem to be particularly popular in India and China and a bit of Southeast Asia. That's where you really get most of the reporting on them. Now, Anatole, you'll be much more familiar with everything going on in the marketplace, but from what I understand, one of the first problems is already the accounting treatment. So, I mean, when you follow the IFRS discussions on whether to treat this as equity or as debt or something in between and where it really falls, that seems quite tricky. For banks issuing them, it doesn't go under core capital. It's the kind of the first extended perimeter, it's AT1. So it doesn't seem to be all that straightforward, and basically it's just a continuing scale from very long-term bonds. And I mean, given how much market players, I think, especially due to regulation, rely on what officials say on how they categorize things, I don't think that's such a negligible difference. So I'm not sure here, but you know the market a bit better.
No, if I could just respond very, it's a one-sentence response to that. Well, there are 2 points. Of course, for banks or any kind of private issuer, there is a clear difference between equity and debt. For governments, there's no such thing as equity, and governments are perpetual organizations, and I think that's a big difference. Now, so that's, I think, in principle, there is a big difference between private sector institutions, especially rather vulnerable ones like banks, which tend not to last forever, and governments. But the more specific thing is, you're absolutely right. I think there would be a difference in not so much in accounting treatment, because the owners of these bonds, it's the accounting issues apply to the issuers of the bonds, and of course governments don't have to have their, governments aren't subject to audits and accounting principles in the way the private sector are. They are subject to rating agencies. So I think the question is, would they be rated in a significantly different way from ultra long bullet bonds? And I don't think that any of the, as far as I know, none of the rating agencies have actually expressed an explicit opinion on this. But from what I've read, and admittedly this is secondary sources, I think there would actually be very little difference from the point of view of the rating agencies, because what the rating agencies in principle are always looking at in governments is their ability to maintain the contractual level of debt service, including redemption. And therefore, from the point of view of an S&P or a Moody's, a bond that has to be repaid in 100 years' time, but doesn't have a sinking fund which is gradually repaying it, probably would not be treated very differently from perpetual. But that's speculation, because I don't think nobody's explicitly asked them that question. But again, I would say this is a market test. Somebody ought to issue one of these things and see, how it is rated.
Peter?
Only some short comments first. I think when we discuss these perpetual bonds, the question is, what do we expect from it? So is it a game changer, or is it just an innovation in the issuance of government bonds? And I think what Anatole says, well, let's try, let's see how it works, is obvious thing to do, but one should not expect too much from it in terms of a game changer, that this will make things different. So it's somehow refining the issuing of bonds, but I think it's not a game changer. And as it is not a game changer, I also don't see that it might be politically difficult to sell this in Germany. I think the German public does not discuss the maturity of government bonds, not major issue. And so I think if the German government decided to issue 100-year bonds or perpetual bonds, politically, I think it wouldn't make any major problems. And the third point is, I would like to hear your view, Anatole. What about the ECB? I think as long as ECB does not change its policy, then these ultra long bonds might have a disadvantage. Thank you.
Sorry, I seem to be the guy here who has to represent what's going on the market. I'm actually, look, Peter, I'm actually inclined to agree, and Philippa, if I were ruling the world, I would start off by issuing 100-year bonds, which would overcome, Philippa, your problem in principle, and then move on from that to perpetuals. Now, the other reason I would do it is for the ECB standpoint. The ECB has actually bought some level, and I don't know what the amount, of the Austrian 100-year bond. So the 100-year, the ultra long, does not seem to have been a problem for the ECB. Now, I don't know, I haven't had time. Maybe they've only bought 10 million euros worth, or I don't know. I think the total issue of that 100-year bond is something like 4 billion euros. But they have bought, so in principle, the ECB has accepted ultra long bonds. I agree with you that the perpetual bonds would be one further step. And so my inclination would be, let's start with 100 years, maybe even 50 years, and then extend the maturity. Where I would slightly differ is I think it could be a game changer ultimately if these issues were taken up with great enthusiasm by the markets, and it turned out that there was a lot of liquidity. They would actually, they wouldn't transform the situation completely, but they would make it easier, not only for European governments to raise money, but also to overcome what is, I think, economically the most credible objection to excessive levels of government debt at very low interest rates. So the argument you often hear from governments is, yes, it's very cheap to borrow, and this applies whether you're borrowing for climate change or for coronavirus. It's very cheap to borrow today, but what happens when interest rates go up again, which they surely will in 5 years or 7 years or 10 years? Now, if you can borrow for 100 years, you can overcome that argument. And I think in a way, these perpetuals are probably even more, or very long bonds would be even more useful for climate change type of investments than they would for this kind of thing, because you say, okay, well, this interest rate is now locked in for 30 years, 40 years, 50 years, or 100 years.
Good point.
So to that extent, it could be a game changer. Yeah.
Good point. Yeah.
Thomas Fricke.
Yes. Not Anatole, not only the market expert, but maybe also the Peru expert. I just didn't understand then the point, because George is writing in his piece that Italy is not able to do that, and that Italy needs the help and solidarity, and that in the end Germans should give this or the others wonderful gesture of solidarity, even if it's in the end in their own interest. But it's so maybe you can explain.
Yeah, I just think George. I just think George is wrong on that. No, he's right. If Italy wanted to borrow 100 billion euros, I think he'd be right. They'd have difficulty doing it. But if Italy wanted to borrow 2 or 3 billion, yeah, no, I think he's actually wrong, because, well, probably he wrote this before Peru came out with its issue of 2.5 billion. So I think from a market standpoint, in terms of a small niche borrowing, Italy would be able to do it. And that would, I think, overcome this mutual guarantee problem, which to me is an insuperable problem and would not be acceptable to Germany. I really don't see why Germany would offer that kind of guarantee.
Can I just come in with another short comment to the political question? So I agree with Peter that I don't think it's a major point of discussion in the public, what kind of bonds we issue. But I think there will be an issue in the finance ministry. And I think that's quite relevant because it points towards where we need to pick up the debate and what we need to change in Germany in the discourse. So here we already have an issue when we talk about issuing longer term bonds, because what happens is when you issue a bond, you don't issue it once and then you never sell them again as government. You issue them in an initial issuance, and then over 2, 3, 4 years, depending on how long maturity is, you sell them again to ensure there's liquidity in the market and to ensure that the market can absorb whatever you issue very well. And the problem is, the longer this period is where you keep continuing selling the same bond, the larger the differences in price of issuance will be. So, I mean, if you say 10 years ago, we issued a bond with 3% interest rate. If we sell this bond today, we won't sell it at 100, we will sell it at 130, because everybody loves a bond that gives 3% interest rate. So what happens when interest rates go the other way around? We sell this bond at 95. And this is where the problem comes in, because then the budgetary department from the Ministry of Finance says, oh, well, so we need to protect us against this and basically have a precautionary fund in order to make sure we don't get a problem with the budget in that year. I mean, from an economic standpoint, it doesn't really make any sense, because I'm not sure what you're guarding against. You're kind of guarding against liquidity, but then not really. But this is, I think, the result of really annual accounting that we have here. So German government looks at how much money goes in and out every year. It's not intertemporal. So the more there's a mismatch with your financing side, which is then over 30, 50 or 100 years, with your accounting, which is essentially annual and maybe looks at 4 years, the more problematic this will get. And this is already, I think, in the way of some further developments in that direction. So this is why we really need to change the debate in Germany and in kind of technical circles in order to get anywhere near long-term bonds.
Do we have questions from various guests who are not on the panel? I know Stefano Merlo, you had one question you'd like to raise. Why don't you take the floor, and panelists,
yeah, sure.
Be prepared to respond.
Yeah, thank you very much. So I just want to raise one issue that I think it was briefly touched but never really delved into. So on the one hand, a government is the best suited at actually issuing these bonds, because of course at some point it will come and collect taxes. It has the force of coercion, whereas the EU doesn't have any of these measures. It still relies on the consent of the different member states. So to that extent, I really question how much could the validity of these bonds be ensured throughout time, given that the EU is still an association of states that need to consent, and every year we see that this permissive consensus can be questioned. So if you take the case of Brexit, is of course the easiest case. So I was wondering among the panelists, how could they deal with this, assuming, and I agree with all of you, that at the moment it will be a great chance, but one needs to think about the future and also from a constitutional perspective, what this would mean. Thank you.
Any response from the panelists?
Well, my quick response is you have identified, the problem, exactly a problem of collective action in the EU. I think they confronted that problem in the discussions in July about agreeing on this coronavirus recovery plan. And they answered it partly by increasing the EU's own resources, which is a share of all the VAT revenues collected throughout the EU, plus the customs revenues, from memory, from about 1% of GDP to something like 1.8% of GDP. So the EU does have its own resources, but they're absolutely tiny compared with the resources of the governments. And I think this is the big obstacle to any form of mutually organized fiscal policy. And I think this has been the original sin, if you like, of the euro, of the creation of the euro as a single currency. But I think what was agreed in July was a significant step forward towards the creation of a centralized fiscal coercion, if you like, resource that can raise revenues. Now, the next big step that needs to be taken, which was discussed but hasn't been agreed, but which the German government is very much behind, and also the French government, is that the EU budget should no longer be subject to unanimity, but should be subject to majority voting. If we get there, then I think the EU becomes a genuinely credible federal fiscal actor in the same way as the US government is. But that obviously is still a big political hurdle to be overcome. The majority voting is crucial.
But I think the question has also another dimension, because the difference between the EU and, let's say, Germany is that the EU could dissolve, let's say, in 2 years. And what happens then with the EU debt? I think that was your question, no? Because that's the challenge. Yeah. So if all the member states decide to leave EU, nobody could prevent them. And of course, then if the EU issues a perpetual bond, who is liable for it? But I don't have an answer, but I think that was a question which is a very tricky question. No?
I think actually, Peter, on that, Brexit actually is an interesting precedent, because as far as I understand, the Brexit negotiations, which of course could culminate in a complete blow up with literally tomorrow, but part of the withdrawal agreement, which was actually signed by the British government last year, was that they recognized their share for the liabilities of the EU that were generated while Britain was a member. So I think at least the EU's interpretation is that all the member states are liable, for their share of the obligations, for instance, of the EIB and so on. But of course, that could be blown up literally tomorrow if the British government says, well, we're tearing up our withdrawal agreement, and how are you going to force us to pay?
Can I ask Peter a question on this?
Please.
Do you think, despite beyond Eurozone and Europe being slightly different, but do you think there's a fundamental difference between a bond, especially a perpetual bond, and the issuance of a currency? Because, if we issued a euro and the Eurozone disintegrates, we have the same problem, no? And the euro works.
Well, that's a different thing, because you can exchange the currency by a currency law that you can do overnight. That's not so economically. Italy would say, okay, tomorrow we introduce the lira at an exchange rate of 1 to 1 or so. We issue. I think this is something we can do easily, legally. I think economically it's a disaster, but with the currency law, you can always change as a nation state the currency that you use within your country. That's not the problem.
But having that on the cards does as much damage to your currency as it does with a bond, no? If Italy leaves the euro.
But I think with the bond, the problem is who will pay for it. So I don't.
But I think there's actually pretty well-established international precedents on that. I think even when the breakup of Czechoslovakia happened, they negotiate, each side had to bear a certain share of the liability. Okay. So I think there are some precedents on that. I'm not sure, but yeah.
INET's research director, Tom Ferguson, I know has a question for the group. Tom, why don't you present
it's actually more like a couple comments, if I could. I would like this proposal to move forward, but I have a bad feeling that it won't. Let me explain it has nothing to do, not directly until you get to the very end, with EU politics. I mean, look, a couple things. First, the focus on the claim that insurance companies need this stuff. Now think about that for a second. I have done lots of things around private markets for a long time. And what the insurers usually do, as far as I can tell, is they'll buy bonds knowing they have to make a bunch of big payments in 20 years. And they'll cover that with a bunch of bonds, and they may build in some factor for a screw up or something, but that's what they do. Now, if you're buying a perpetual bond, you're not going to be able to buy a large lump sum payment at a certain period in time. You're going to have to buy instead a ton of small payments coming in. That's the perpetual part, the interest rate that's paid. Now, think about that. Right now, the discussion has begun about how to deal with a rescheduling of Italy. That, it's not in public, but it's there. In effect, what you'd have to do with, say, in the case of the EU, is load up on, well, a somewhat uncertain payment thing as you go down the pike. You'd have to just take on more and more risk over time. And I don't think people are going to be willing to do it. Now, the case, then they can ask the question, what's going on with those perpetual bonds that people have been buying? When you study those, I think what you see is this. The market demand for those is pretty thin, and people comment on it. Yeah, the Austrian one was oversubscribed, but now let's go back to what the conditions are. The whole point of quantitative easing is to make folks go out the yield curve or do something to take a bigger risk, since they can't make any money at current interest rates. And as observers of the Austrian issue said at the time, this is really a bet on a quiet century. This is not a good bet, I would think, over 100 years. But you are back in, you're already on this slippery slope where you've got a decaying financial system, meaning you got lots of bad banks, you got lots of countries with serious trouble, and you've got official interventions to try to sort of make that better. Now, what happens is, it's as Ed Kane, my friend, is always commenting, you get more and more efforts to bring in the public sector so the private guys can offload their risks. In this case, what you're doing is you're encouraging people right now, fund managers who can't get yield, who won't be around in 5 years, to go in and buy, say, I think the Austrian thing was something like just under 0.9 as an interest rate. That was better than you could get with a lot of other stuff. So these guys just went in and bought it. They won't be around to take the losses. You are, in other words. We have known for a long time that the efficient markets hypothesis is really not true. And that when you get into cases like we're now in, very complicated political economic interactions, it's especially crazy. And so I think what unfortunately you're seeing here is a kind of Rube Goldberg contrivance that really has to deal with the fundamentals, but can't. And so that's I'm sorry to be so pessimistic. I'd love it if it would work. But that's the problem of who will pay over 100 years. If you tried to do a lot of these, would become much more acute than it is right now. And the discussion would soon focus attention on those fund managers who won't be around in 5 years.
I had a question from Maria Schweinberger.
Yes, hey. Hi, everyone. Thank you all. I'm primarily concerned with how we can build a market for these bonds, right? Separately from the political issues around these. And I'm interested in your views on what the difference would be to the US government issuing a perpetual bond. So my first take on this, or my first guess, is that that wouldn't be so much of an issue, because emerging markets governments and central banks would automatically buy these types of perpetual US bonds. So there is some sort of automatic or like sort of already existing market for these bonds. And I wanted to see whether you share this view and what your thoughts are on this. So if my assumption is true that the case is quite different in case of the Euro government issuing a perpetual bond, then the question is, what do we need to do to build a market? And I think here, as was already mentioned, the ECB is key, whether they would accept these bonds. And then I think another issue would also be changing capital rules for banks and insurance and other insurances and other funds, and allow them to hold these bonds. And my question for you is, what other regulations can you think of that may need to be changed to build a market? Possibly, I think this could be built into investment treaties where the EU asks like a country that they conclude that they enter into an investment treaty with to buy these bonds or to hold them, or to build into the investment treaty certain incentives for that country to hold these bonds. And then my last point is more with the head of a lawyer. I'm wondering whether there's a constitutional issue there in issuing perpetual bonds. So when as a citizen, I get really uncomfortable thinking that some elected or not elected person takes an eternal decision, right? So that would mean, as a citizen, I feel much more comfortable if we built in some very generous redemption rights for a government issuer. But then once you built in redemption rights for the issuer, you would probably also have to build in redemption rights for the investors, right? And then you get into a point where then you can easily get into territory where we would have to decide and discuss the nitty-gritty design features of these perpetual bonds, right? It's not just about interest payment and principal payment. It's also about interest step-up rights and other redemption features that can actually weigh quite heavily on a government. So I'll leave it with you. Thank you.
Any comments from our panelists? We're coming to a close here. And so final comments that you have. Thought we'll start with Peter Bofinger and
a short comment on what Tom said. I think that's a very good point he made, that insurance companies, of course, they need to invest in safe assets. And of course, a 20-year bond is not safe, but if you have obligations for a period of 20 or 30 years, you can perfectly hedge it. And compared to this, the perpetual bond is completely unsafe. I think that might be a real problem for insurance companies to buy these bonds.
Anatole?
I make two quick comments. First of all, in response to Maria, and actually much of what else has been said, I think these are all arguments for starting out with very ultra long bonds, whether it's 50 years, 100 years, seeing how that goes, and then maybe taking the next step into perpetuals, because none of the points Maria mentioned, actually none of the objections would apply to ultra longs of 100 years. They have redemption, etc., etc. But in economic terms, they're not significantly different from perpetual bonds. That's what. In reply to Tom, though, I would say I think you're completely wrong about the way that that the investment markets work. And in fact, I would say even among the long-term investors and insurers, and the reason is your description of what their business model is absolutely right, and they need to match long-term liabilities. But you're wrong just for a very apparently trivial contingent reason, and that is that the vast majority, the great bulk of the assets of the safe assets that these organizations are buying, even pension funds, are much shorter, have much shorter maturities than their liabilities. Most bonds, especially in the US, are 10 years or less of maturity. And therefore, in order to create an average maturity of their assets which roughly matches their liabilities, they actually need, and this is why they're buying this stuff, and I agree with you completely, from an investment standpoint, they're crazy. I mean, they will lose money on this, but they're buying these ultra long instruments in order to stretch out their maturities using so-called convexity and so on, so as to turn holdings of 10-year treasuries into equivalent duration of 25, 30, 35-year maturities. And therefore, you know, I think we've all agreed you couldn't replace the entire global bond issue with 100-year bonds, but to add that as an element, and potentially worth hundreds of billions or even trillions of dollars, is, I think, feasible even for these very cautious, conservative, prudent institutions, because right now they're not actually succeeding in matching their assets with their liabilities.
Okay, Thomas Fricke.
Yeah,
Any last thoughts?
Yeah, just quickly on the issue that I think we didn't clarify completely, but is there any risk sharing or not in that? Is there something to explain to the German public or to the Dutch and the Austrians and so on? I suppose that it doesn't make sense if it's not something where we need to ask these countries to do something, solidarity, whatever. So supposing this, I think what's missing is a more convincing answer of how or why we are doing this. I mean, we all agree and we said, well, it's evident and it's clear we need that money. I think that's not so clear to people. That's not so clear to people. Why should Germans guarantee or have a solidarity act to Italians? It was very clear last summer because there was a very dramatic situation last spring, and it was obvious Germans were also in trouble, to talk about the Germans. That's not evident, and I think it's worked quite well. The Next Generation EU, that is not bad as a narrative, but I think such proposal needs a much more convincing story, you know, to tell people why should they do that, why should governments do that, and why should be solidarity with Italians. So that's just my last idea point.
Okay, and we'll begin. We end where we begin, Philippa.
I mean, I would just agree with it would be quite exciting to see more ultra long bonds issued, and maybe that's something Germany should look into, or definitely something Germany should look into. And then on the EU level, I just hope that we find a way forward, and whatever that way is that, you know, makes things work. I think we've got to be pragmatic.
Okay. Thank you. I want to thank all of our panelists and Jay Poppington and YSI for putting this together in a very short amount of time. Thanks to George Soros for stimulating everybody with his Project Syndicate article, and to all of you who made comments. Jay, any last words from you?
Just wanted to invite you all to participate in the Political Economy of Europe Working Group. I think I misspelled the email address that's now in the comments, but you'll find Stefano and Salome online. We will be continuing these discussions going forward. So if you're interested in this type of debate, please join YSI in general if you're not a member already, but specifically the Political Economy of Europe Working Group. And again, also from our side, we're really happy and excited to have had this discussion. I think there's many questions that have come up, but I think it's well worth debating both the overall ambition of the proposal to save basically Europe, to save our climate, to have big questions and big challenges in mind about collective action, because that's, I think, a problem that we all have to think about in some way. And proposals of any kind are really, really welcome for us to spur this kind of conversation. And then also to bring in the technical expertise and the feasibility and the political willingness that has to be slowly delved into. So I'm really excited about these conversations, and just again, the invitation to join us in YSI to continue the debate. Thank you, Rob, for the moderation, and thank you to the panelists as well.
Thank you, everybody.
Yeah.